Today, all eyes are once again on the Fed, an increase of 0.25%, taking US rates to 4.75% is firmly expected, but we'll see. Surely more than 4% rate hikes and interest rates combined with tightening economic conditions increase the probability of a big downturn. Is the Fed then possible to engineer a soft landing, as mentioned by many? Even then, what is a soft landing? The risk of policy error restoring price stability without killing the economic growth still remains. One of the more prominent questions being asked out there lately is by how much can earnings possibly contract? Can the reopening of China soften the blow, and to what extent is this beneficial to South Africa and commodities? Then, of course, from an SA investor perspective, there's the Rand, USD, onshore, offshore conundrum. We've seen our increasing offshore exposure to the match 45% for those managers who did over the past 6 months didn't really pay off. But what is the way forward? Welcome back to Boutiques on Wednesdays. We'll be bringing some of the top asset managers locally and globally. And to our lovely audience out there, I can't say it enough. I know I say it very frequently, but we will remain ever grateful for your continued support. Joining us now from Fairtree is Jacobus Akok, macro strategist and portfolio manager, to share the views on how this all comes together in the select BCI Balance Fund. Jacobus, it's really great to have you with us, and we thank you for your time and really look forward to your presentation.
Thank you, Eugene, and welcome to everyone online. I'm looking forward to our session. Yes, in the next 30 minutes, I'll take you through the select BCI Balance Fund, the performance, our outlook for 2023, and then I'll finish off with how we are positioned in this environment, trying to take advantages of the opportunities and all the challenges. So let's jump into the performance. We took over the management of this fund in November 2020. Since then, since inception, we've managed to eke out 16.6%, so outperforming the medium CSA peer group by about 3%. Over the last year, so over 2022, we've gained 6.5%, outperforming the median in the CSA peer group by about almost 7%. And this year, we've managed to get to around 7% already. So for all the hard work last year, we've managed to have a good start this year. But as I'll show you in the macro section, there's still a lot of challenges ahead of us. I think what's key to point out here as well is that this fund aims for CPR +5, and we've achieved that over the long term. In terms of the actual attribution, and this chart shows how the different components of the balance fund or the different asset classes has performed against its respective indices. So you can see the outperformance.
Sorry to interrupt. I don't know if it's just me, but I can't see your slides. I just want to check, Olga, are you able to view the slides, or is it just my viewing that's the problem?
No, I also can't view the slides.
Yeah.
You just need to share.
Sorry, maybe just start reshare again, if you don't mind.
Let me do that.
It's virtual sessions, so never sure what you can see, what I can see. Right, it's coming through now.
There we go.
Yes.
Sorry about that.
No stress. Put it in full presentation mode.
Okay, you can see that.
Perfect. Apologies for that. Great.
All right, so I'll jump back into the performance so you can actually see it. It's there, it's real. 16.6% since inception, outperforming the CSA peer group, and over the last year, 2022, 6.5%, and a good start to this year. So then if we look at the attribution of the fund, the different asset classes relative to its respective indices, where the outperformance come from has been mainly from security selection in SA equity, global equity, and emerging market equities. So strong equity security selection. And within the SA equity side, are overweight towards energy, global defensive stocks, Naspers, diversified miners have worked for us. And on the global side and EM side, again, overweight energy, materials, a selection of consumer discretionaries, and also underweight in technology has worked well for us against our index. The asset allocation has also performed. It's added 0.3% to returns over the last year. We've been underweight global equity throughout most of last year. We've been underweight South African properties, and we were overweight commodities, and fixed income. And within fixed income, both local as well as global fixed income has worked well for us. In terms of the longer strategy track record, the 5-year return now sits second in its peer group, and the 3-year return third in its peer group. And I believe we've also been nominated for a Raging Bull Award on the 5-year track record. So those results will come out obviously later this month. What I want to just maybe, the last thing I want to point out is that this outperformance hasn't just come from a very strong local SA security selection team. We also have a global team, and they've performed really well over the last few years as well, and particularly last year. And what this chart shows is looking at global equity returns of fund managers versus their respective SA fund returns. So where you want to end up, and this is roughly where Fairtree is at the moment, with our global equity fund returning over the last 3 years, about 15% and more than 15% coming from our SA equity funds. So you want to be in this higher right-hand side of the spectrum. And so both on the 3-year and the 5-year, the fund has benefited from strong teams. The last thing I would want to say about the balance fund is that the different components are managed by different specialists, and we believe that enhances the capability to really add alpha via security selection to the fund, as well as additional diversification. Right, but let's talk about the macro outlook and how we see 2023. And this is a short summary of how we see the world around the big different macro variables, and also how we are different to where consensus is sitting at the moment or moving towards at the moment. So right at the start, inflation, top of mind, has peaked. We believe inflation will fall sharply over the first half of this year, but we don't think inflation will fall to central bank targets. The market certainly thinks that inflation will get back and stay at that 2% level. We think there are challenges ahead that will make it difficult for central banks to get and to remain at those targets. Secondly, central banks, we think, will remain hawkish, but they will start to reduce the pace of rate hikes. So tonight we see the Fed potentially taking the next hike to 25 basis points. And then they will start to pause, maybe later this year or in the first half of this year for the Fed, and the ECB just after the second half of this year. So the Fed, we think, could get to a peak of about 5%. The market then prices in or starts to believe that there will be cuts coming from the second half of this year. We disagree with that view because we think inflation is a bigger problem. Growth, we expect that there will be a recessionary environment in developed markets developing over this year as a result of the very tight and rapid increase of rate hikes last year. So this high or tightening of financial conditions, high cost of living, that will still filter through activity this year. To some extent, that will be offset by a decent consumer in developed markets. They're sitting with excess savings. Jobs markets are still remaining robust. Energy prices have come down, and China is reopening. So we recognize that those are offsetting factors, but we still think we'll get to what we call a shallow recession in developed markets, and not a soft landing, which is essentially below trend growth, but still positive growth. In terms of the geopolitics, yes, we have seen a little bit of easing around geopolitics between China and the US. We've had some very constructive bilateral talks over the last couple of months. So we've seen some of those tensions ease, but longer term, we still think that the containment strategy by the US to contain China, by curtailing their access to advanced technology, and China's Taiwan strategy does mean that there's longer term risks still at play. We also have later this year more political uncertainty from the US potentially, as we'll see the debt ceiling needs to be raised later this year. So definitely the second half of this year, I think there are more risks developing. First half could potentially be better for markets. So in terms of the growth cycle, we clearly see that developed markets are still slowing, while EM and specifically China are accelerating. So they will have improved growth this year, whereas developed markets will have lower growth. Looking at the different regions, therefore, relative to consensus, we are less optimistic about US growth. We're more optimistic than consensus about Chinese growth, and roughly in consensus with the rest. Maybe we think there's a little bit upside in Europe and a little bit downside on the SA number. But overall, we think that we're still sitting with the slow growth environment into the developed space. Emerging markets are looking better. If you remember, cast your mind back, obviously they would be benefiting most from the China reopening, benefiting from higher commodity prices, from a weaker US dollar, but also they were the ones that were able to hike first going into the cycle, and most likely also be able to cut first coming out of the cycle. So that will provide support to consumers in the EM space. And also, EM hasn't faced the same inflationary problem that the developed markets has followed. So a bit of divergence taking place, and this divergence obviously will also be driving the dollar weaker. Just focusing on the US for a second, this is the growth tax indicator. It consists out of the dollar, oil, and 5-year rates. This leads the manufacturing cycle typically by about 12 months. Looking ahead, we still see some downside in the US, but we do see a bottoming later this year in the US. So in the interim term or the short term, we do see a little bit more downside. And this downside we don't think is reflected, especially in developed market earnings estimates. And therefore, there does remain some risk to equities from a growth perspective. Looking at the inflationary outlook, yes, inflation has peaked. You can see headline inflation now coming down across most of the developed world. Inflation is not a problem in China. It may rear its head maybe later this year if there's a very strong reopening and China becomes a reflationary force, whereas last year it was a deflationary force. So that's one aspect to watch. But you can see inflation coming down, and rapidly so, across most of the developed world. We think that stickiness of services inflation, in particular, the shelter or rent component within these markets, will keep inflation probably more sticky than what the Fed would want it to see. We think that labor markets remain tight, and that leads to potentially still sticky wages as well. But apart from these cyclical aspects, I think if you look longer term, the world which we're facing over the next 10, 20 years is very different to the one that we experienced over the last 20, 30 years. And we are facing a world of potentially deglobalization, onshoring, bigger governments, less savings, higher investment, greenification, a lower support ratio, which means that there's more people retiring and spending relative to the amount producing. So demand grows relative to production, which means it becomes inflationary. We think these factors are all leads to potential inflationary pressures in the future if we take a longer term view. Clearly, the bond market and the markets are of a different view. If you look at this black line and the green line, these are the 10-year and 2-year break-even rates. This is what the markets implied or expectation of inflation is for the next 2 and 10 years. And clearly you can see the market thinks inflation will come down to that 2% level and remain there. The experience obviously for Main Street has been very different. And we think that the only way that you can get there is by the central banks inflicting more pain. So keeping rates higher for longer to get to these levels. But given what I said earlier in terms of the amount of still fragilities on the inflation front, we think that the risks therefore remains to the upside on these inflation prints. So if we look at what the Fed is saying at the moment, or this is the Fed funds futures, what they're implying at the moment, and the orange line shows what the market thinks rates will get to by the middle of this year when the Fed peaks, where it will get to by the end of this year and then also by the end of next year. So you can see that the green line shows that the market is thinking or expecting that the Fed will start to cut rates later this year. So we will be back at 4.5% by December this year from that 5% level, and we'll be below 3% by the end of next year. We don't agree with the market on this metric. We don't think that there will be scope for central banks, given the inflation outlook, still to be able to cut rates to below 3%. So this adjustment will also be, I think, means some volatility for markets. You can expect the Fed tonight to push back against this view that there will be cuts coming forward. I don't think that they will guide towards any imminent cuts or any imminent pivots. And I think this could mean, some volatility for markets over the next few months as the market needs to grapple with the Fed pushing back against this. On the labor side, and why we think wages could remain also sticky, is that there's still this tightness in the labor market. So job openings remain at about 10 million, but there's only 5 or 6 million people that's unemployed looking for jobs. So you've got to narrow this gap between the two. And this means that the labor market remains effectively very tight. One upside for the consumer in the US is that as inflation comes down, their real wages would start to increase. So nominal wages have risen to about 6%, but with inflation coming down, real wages are starting to improve again. So this is offsetting, and this is why we're saying we don't see a deep recession, but we see a shallow recession, in that we see that the consumer are still able to buffer some of this tightness. Looking at Europe, we see that energy prices have come down quite significantly. We saw milder weather in the winter. We saw that consumers have changed some of their behavior, and also that European nations were able to procure gas from the Middle East and from the US. So clearly, prices have come down. That's taken a lot of pressure off the consumer. And so we're starting to feel a little bit more positive about Europe, even so relative to the US. However, there are still some risks the second half of this year, when again, these nations or European nations will have to refill the gas reserves, but this time with absolutely no Russian supply. Last year, they will still had some access to supply early on. This time, they will have to do that without any Russian supply. And so I do think that there are some risks again to these energy prices in the second half of this year. So as a result of these energy prices coming down and alleviating some of the pressure, sentiment has picked up in Europe. You can see manufacturing, services, consumer, general economic sentiment have all started to increase. And I would say not just because of the energy spectrum, but also because as China reopens, they demand goods from Europe. Europe is a more open economy than the US, so Europe will benefit more from a China reopening than the US. And later this year, we'll also potentially see how Europe may benefit from increased tourism, increased spending onshore from Chinese visitors and travelers. So sticking with China then, we had the policy conference in October last year, and yes, there were some negative headlines around the conference. We look at the conference slightly differently. We went through all the different documents that they've produced over that time, and our read was that there's definitely still a keen priority for growth to support a private or foreign investors and private investors, private markets. And so you can see as a result, after the policy conference, markets have started to rally. Mostly also because of that reopening that took place. So Hang Seng is up, I think, 50%, industrial metals is up 25%. And in general, these markets have done a lot better. But they came from a very, very tight regulatory environment in which policies were just unsustainable. And these were the policies that the authorities in China have set out over the last, or the prior 18 months, health restrictions around zero COVID, property restrictions, the crackdown on platform companies, the question mark about what the economic ideology is, concerns about delisting and geopolitics. And this has all led to property defaults, investors calling China uninvestable. We've seen some outflows, we've seen property defaults. And the authorities definitely took the conference as a catalyst after Xi has ingrained his third term, so he secured his third term. There was less risk of him potentially losing that term. So they made a U-turn on a lot of these policies post the conference, and to refocus on social stability and financial stability, get growth higher, to get confidence back into the economy, and also on national security. So we look at all the different policies. I'm not going to go through every single thing here, but all the different policies that was set out after the conference, and then all the different U-turns and changes that was made. And if you go through this list, you will see there's definitely a drive to get confidence back in the economy. Even on the geopolitical front, she has had many bilateral meetings with G7 leaders, with Biden in the Middle East, trying to set up these strategic partnerships again, which is very different, as on a comparative basis, what you saw from somebody like Putin. So in terms of confidence, it's still very low. We think that, from these low levels, there's ample scope for confidence to start to rise again. It will take some time because it's not just the reopening that will instill confidence. We need to see, improvements in the property market as well, jobs coming back. But as China reopens, a lot of that spending will go into the service sector, and the service sector is typically very labor intensive. So we do think that jobs will also benefit, and that the Chinese average households will start to improve their confidence in the economy and the leadership again. I think this chart is very important because as China reopens, it has got a lot of pent-up savings that it could utilize. This chart shows that household deposits on a 12-month rolling basis have increased during the zero-COVID time period, when households, like in the West, weren't able to go out and spend. At the same time, they weren't buying properties because they've lost all the confidence in property developers' ability to deliver these apartments or properties. So you saw deleveraging by the household at the same time that you saw an increased savings. And this has led to pent-up savings, which we saw from different analysts to about, say, half the magnitude what it was in the US after the pandemic. So about 3 to 5% potentially of GDP. And as this filters through the economy over the next few quarters, we think that will support consumption. Around goods, services, luxury, tourism. We do expect all of those to come back. China obviously is a big importer and utilizer of commodities, as you can see, just some of them. And we do think that on the margin, this improvement in demand will also provide some improved demand for these commodities that's already struggling as a result of low supply and low investment, capex investment that took place over the last few years. So these commodity prices, we think, still have some upside even from these levels. South Africa should benefit from better commodity prices. So if you look at the black line, the terms of trade have risen more recently. And what happens then is that the rand responds, and you can look at the real effective exchange rate. It starts to rise, it starts to appreciate every time that you get a better terms of trade. It didn't do so this time around. You can see that the real effective exchange rate still remains at a deep discount, so cheap relative to its own history. And the result of that is, or the reason for that is, we know has been as a result of load shedding and the energy crisis which we're facing. So South Africa is actually facing a decent external environment, or an improving external environment, but on the local side, it is struggling. And this is the reason why, if you look at over the last few years, the amount of hours of load shedding spent in the different stages. Last year, I think this comes to about 3,700 hours. And the impact on growth just for the fourth quarter of last year, SARB has estimated to be about 2% annualized on growth. So clearly, these electricity outages is curbing small businesses, it's curbing production, it's curbing agri production, and it does put a lid on the potential growth rate of the country. When do we see this potentially, these pressures elevating? Well, this is from the National Energy Crisis Committee that sits within the presidency. This is their plan. This is what they say would potentially happen. I agree, this is very ambitious, potentially too ambitious. If you listen to what commentators in the market are also suggesting. But if we get only half of what is suggested in 2023, then we will take load shedding back to stage 2, around stage 2 again, which means that we will probably sit with load shedding for the next couple of years, and that will remain a hamper on growth. And that's why, if you look at our portfolios, on the SA Inc. portion of the portfolios, we still remain fairly underweight. This is retail sales in volume terms, so it's real retail sales. You can see the consumer continue to suffer as a result of high food prices, high fuel prices still, interest rates that have risen, unemployment, and we don't see yet a turnaround in these metrics. The only, I would say, positive that we could look forward to at this stage from a policy perspective is if we look at the SARB, we now see that they've hiked rates to 7.25%. Inflation is coming down. Typically, in the past, when inflation has come down and below the SARB's rate, they've stopped hiking. So we believe the SARB is getting to the end of its hiking cycle. This could have been the last hike. Wouldn't be surprised if there's one more, but I think we are getting to the end of the hiking cycle. And unlike maybe the developed markets, I do think SA is in a position to potentially start to cut earlier than the developed world. But it won't cut unless there's more clarity around the Eskom problem. South Africa, however, remains still very cheap. So if you look at our valuations relative to the EM, the rest of the emerging market space, we still remain fairly cheap. So, obviously there's a lot of our names that are externalized, so we get our revenues from overseas, and we like and prefer those names. But as more money flows into the emerging market space, people are starting to realize that EM potentially have a bit of a tailwind on a cyclical basis. South Africa will also benefit as it does screen cheaper than most of EM. So overall, this is our asset class outlook. We think the dollar will weaken because of this divergent growth dynamic. We are constructive on commodities. We do see improved demand, a weaker dollar, and still a lack of supply in investments. We prefer emerging market assets to DM, and especially those that can cut rates, that has got access to China or links with China. We like global, or more specifically US treasuries, as a hedge against a potential recessionary environment. We are cautious on US equities though, because of the reasons mentioned earlier. We still think those earnings are elevated, and therefore we like more emerging markets and ex-US. And yeah, we prefer South African equities with those offshore earnings potentials. So if I look at just positioning the last two slides, first, what we did last year, you can see we came into the year fairly defensive with SA relatively underweight. We took that in the last quarter to neutral, to slightly overweight on a tactical basis during the last quarter. That has benefited us. We've kept our underweight in global equities, and we've increased and opened up this non-SA bond exposure, which is US treasuries, as a protection against this recessionary environment potentially. And we've kept our commodity exposure. So overall, we are positioned for, I think, three things: a better China, high inflation still, and lower growth. And we play this by being underweight equity still, but neutral South Africa. And we use those as funders for commodities, SA and global bonds. And overall, we are overweight foreign assets relative to Rand, and about 6% therefore underweight equities in total. I think this is all I've got time for now. Eugene, I don't know if there's any questions.
Yeah, Jacobus, thank you very much for that. Very insightful indeed. And to your audience out there, the Select BCI Balanced Fund available on most of all the big list platforms. Jacobus, a couple of questions. You made short reference to it, and it speaks to DM versus EM monetary policy, and a question from Tavonga, the audience, one of our audience members. What are the odds of emerging market monetary policy decoupling from developed market monetary policy? In other words, EM starts cutting rates while developed markets are still hiking or at a pause. And more specifically, how does one respond to this macro dynamic from an asset allocation point of view?
Yes, so I think that's a very important question. because that's exactly what's playing out at the moment. Remember, as a result of the pandemic, developed markets were able to respond very aggressively, by shoring up demand. So you sit at home, you still receive checks. At the same time, they cut off production. So you had this overhang of more demand than actual supply, which has become very inflationary. Wages also started to rise because of the tight labor market dynamics, which we saw not just in the US, but also in Europe. So as a result, we think that the inflation problem is bigger in developed markets than in emerging markets. And therefore, taking a longer term view, yes, emerging markets that's also now more linked towards China and benefiting from a growth perspective, potentially more so than developed markets, will be in a position to cut rates. As these inflationary pressures come down, was less of a problem in EM than in DM. How do you play that? The way I see that is, first of all, as growth improves and central banks in the emerging market space starts to cut interest rates, you want to have exposure to both bonds and equities in that space. So be overweight emerging market equities in the space. They also, from a valuation perspective, are spreading much better than the developed markets, and specifically than the US. So I do think an allocation towards EM, both equities and bonds, is warranted in this environment.
Thank you. And I can see that if I look at your portfolio construct and some of the holdings in the actual fund, you've got, with your offshore allocation, very specific allocations to your global equity fund and your global emerging markets fund. My numbers might be a little bit stale. I think global equity is about 8.8, close to 9%. Emerging markets fund or global emerging markets fund is close to 8%. A lot of people will say, but SA is already emerging market. Should I allocate more money to emerging markets? You made the point. Good opportunities there, but in that emerging market fund, what is that opportunity set, or what are you buying, and does it include things like mainland China stocks?
Yes. So within I think your numbers are roughly right in that we're trying to be 50-50 on a total global exposure, 50% in emerging markets and 50% in global. Relative to our index, that is only the MSCI World, which doesn't include, well, it includes a little bit of China and some of the smaller or other EMs, but we have a large overweight EM relative to that index from that perspective. So, and within the DM portion of the fund, we are underweight the US. So we are much more, tilted towards EM overall. Within the EM space, we like those markets that has got exposure towards China and the commodity story, so commodity producers. But we don't like those that's actually commodity importers. Like, for instance, India, which has done well. We've been underweight India for a very long time. We remain underweight India. We've decreased that underweight slightly. We're underweight India. We're underweight Taiwan. And that comes as maybe as a result of the fact that we were underweight technology stocks in the fund. So some of those very high valuation markets we are underweight. Liking markets that's commodity intensive, and we also have some selected global discretionary names, which some is definitely in China, which we're overweight. So Chinese listed stocks, which we're overweight. I think Pandora is one of them, for instance, which we've done well in. And then obviously the exposure towards Tencent has also worked for us over the last few months. So we do see a variety of opportunities in the EM space, not just commodity linked, but I would say China linked to some extent, also being underweight technology. Overall, maybe I'll just say overall, we have more recently tilted the portfolio from being more cyclical overweight to more defensive. So we've become a little bit more defensive and have trimmed in this rally the cyclical exposure a little bit.
Yeah, Kobus, we've seen how people can get caught out being the wrong side of currency, even though global selection or global securities may offer good value. But I mean, you mentioned as well, if you look at currencies, that your views are on the short term that the dollar could soften a bit, so probably beneficial to some emerging market currencies, maybe not as much for the ZAR, because we've got our internal problems, like you mentioned. Your global exposure at the moment, overweight to your SAA. I see you didn't adjust your SAA. Some managers moved the SA up with recent changes to Rec 28. They moved it to 30, 35. We've even seen some managers pushing their global exposure up to 45, and a bit of a calamity, I think, in December, if you were at those positions. But what is your views just from a currency perspective? Yes, there are very good opportunities globally, especially in the emerging market space, the comments you've made now. But what is the odds of the rand really gaining or the dollar softening significantly, and that offshore exposure can really hurt you in the short term?
Yeah, so there's actually a few things I want to answer there. So let me start off with the comment about the global exposure. So what you see here is the strategic asset allocation at the end of last year, right? We are actually changing our SAA, and we are actually increasing our global exposure by about 10% and taking down local exposure by about 10%. This is an exercise that we've done last year. We came to the conclusion that we want to change it, but we did realize that in terms of timing, it wasn't the best of times, So we are in the process of going through and using market dynamics to figure out when is the best time to change it. Because last year, if you were overweight global equities, then, or if we had run global equities at the pace in which we want to run it now, we would have been 1% less on the overall fund. So I think timing is important. So you will see that change. In terms of the dynamics, and specifically for the dollar, we do think that the dollar will actually weaken on the longer term basis. The dollar is very much stretched in our view in terms of valuations. It's broken through its 200-day moving average. It's a very big momentous currency. So with this breakthrough the 200-day moving average, we do think there's more downside in the US dollar, and therefore other currencies should benefit, including the rand. So we think, stripping out all the local issues, the rand should be trading at below 16 to the dollar. And we can get there, but I don't see yet the risks to growth, the risks to inflation, and the risks to corporate earnings fading in this environment in which we're sitting with these electricity issues. So from a valuation perspective, we like emerging markets. We think that they are struggling with their own issues. If you look at Peru, if you look at Brazil, that they each have their own issues. But overall, as the dollar weakens, and I think that is the key driver here, it's the view on the dollar. These currencies will see more favorable upside. We also see big flows into the EM space, which we haven't seen for a couple of years. We're now seeing flows coming back into the emerging market space. Just using South Africa as an example here, we've dropped the foreign ownership of our bonds has dropped from 40% to about the low 20s. So there's still potential upside for foreigners coming in, buying our bonds at these very attractive yields. And that is not just SA, there's more examples across the EM space.
Very good point there, indeed. Jacobus, unfortunately, we're running out of time. I've got one last question from the audience, Savonga again. On inflation-adjusted earnings, we are seeing very attractive valuations emerging with regards to European real estate and developed market real estate. Too early to close, underweight's best, and shift back to neutral. So your views on European real estate, developed market real estate, is it really sectors that you're looking at and maybe think of including or holding in the fund?
Yes, so our global property is managed by Rob Hart. It's a small portion of the fund, but the index is very diversified across US, Europe, and Asia. The fund underperformed last year as a result of being overweight Europe in the beginning of the year, but we hold on to that position, and it's now starting to benefit due to that overweight. So we are invested and do have exposure to that to the European real estate market, and we think that with the conditions in Europe starting to look a little bit better, that there are some upside. Look, it is the sector is very much tied to the interest rate cycle, and that's why it came under a lot of pressure. But that's why you can see it's fairly neutral to slightly underweight in the portfolio at the moment. So yes, we do have exposure to those.
Thank you very much for that, Jacobus. Like I said, we're unfortunately out of time. Definitely strong evidence of your local and global security capabilities, with strong outperformance on the peer group by your fund and your team. Well done with the good work you're doing. We're really grateful for that. To our audience out there, just a quick reminder again, next week, Wednesday, 8 February, we're joined by Vanani. We're going to speak about fixed income again, very interesting environment, especially with high yields being offered at the moment. So please join us next week, Wednesday. Jacobus, to you and your team, and Ryan for arranging us. Thank you so much for coming on board. We really appreciate it. To the BCI team, thank you for setting us up. And to our lovely audience out there, thank you for your support. We remain grateful. And until we chat again next week, Wednesday, keep well.
Thank you, Gene.